This is Al Brooks, and this is my price action trading course. This module has to do with trading channel reversals. Many reversals begin with a breakout of a channel that fails and reverses. The market then usually tests the opposite side of a channel. And once it gets to the opposite side of the channel, it either breaks out beyond the channel and begins an opposite trend, or it reverses again and the channel just continues to grow. There are many kinds of channels. Anytime the market is contained between two lines, it's in a channel. For example, a wedge is a channel, a triangle is a channel, a trading range is a channel. This particular module will be discussing mostly channels that have approximately parallel lines. You can see the module on channels and the other modules on wedges, triangles, and climaxes. When the market's in a channel, you really only need to see one of the two lines. You either need to see the trend line or the trend channel line to know that it's in a channel. The market is in a channel if you see one line, even if it does not look conventional, and there's always an opposite line even if you don't see it, or even if it doesn't look right. Here's an example. We have a clear trend channel line along the lows, so you have to assume that the market is in a channel, even if there's no obvious upper line. The market poked below the bottom of the channel and then had a bull reversal bar, so it might be trying to reverse up. You can see that it rallied on the right hand side of the chart. This high is an obvious point to use to construct an upper channel, but when you do, it's not parallel, so that doesn't look as conventional as you would like it to look. You could do a best fit channel across this high, or you could do a parallel from this trend channel line and drag it up and anchor it to this high if you want to have a parallel channel. Otherwise, you can just draw this line, even though it looks like an unlikely top of the channel, and then trust it until the market proves that it's not paying any attention to that upper line. When you extend this line out, you can see that the market, after it broke below the bottom of the channel and reversed up, it eventually worked its way up to the top of the channel. The channel created by these 2 points, even though it's not parallel with the lower channel. So why pay any attention to channels? It's because they offer opportunities. When the market tests the top or bottom of a channel, it either breaks out and then goes for some kind of measured move, or it reverses and goes to the opposite side of the channel. And in both instances, the reward can be much greater than the risk. And since the probability is never below 40%, you have a very good trader's equation. The market is always in a cycle. It's either in a trend or a trading range. And once it's in a trading range, it then eventually breaks out into another trend. A trend, there are two types. It starts with the breakout phase, and then the trend becomes more two-sided, and it enters a channel. And the channel eventually weakens to the point that it becomes a trading range. Okay? As part of the market cycle, channels usually weaken and become flatter, and then the market enters a trading range. A channel is a hybrid between a spike, a breakout, a strong trend, and a trading range, and it's a transition between the breakout phase of the market cycle and the trading range phase of the market cycle. Every bull channel is the same as a bear flag, because most bull channels have bear breakouts, and they should be thought of as bear flags. Every bear channel should be thought of as a bull flag. Most of them have bull breakouts. So here we have a very strong bull trend and a very tight channel. And if you only look at this point and to the left, you'll say, wow, what a strong bull trend. On the other hand, a channel usually becomes part of a trading range. And if you look at the entire chart and you say, well, where did the trading range begin? You probably would say, well, it began over here. But that's also the start of the channel. Remember, channels usually evolve into trading ranges. Even the strongest channels usually evolve into trading ranges. A bull channel, it functions like a bear flag, so chances are it'll have a breakout through the downside, exactly like a bear flag. Here's a strong bear channel. It's fairly tight, very strong bear trend, right? But every bear channel should be thought of as a bull flag, and the odds are it'll have a bull breakout, and then it will transition into a trading range. And that's what the market did here. We have a bear channel, a bull breakout, and then the market transitioned to a trading range, even though at this point it did not get to the top of the channel. Most channels end with a failed breakout. So here we have a bull channel, and you draw the trend channel line along the top, and the market broke out of the top, but it did not close up there. The close pulled back, and that tail represents a failed breakout. Remember, every tail is a failed breakout, even if you don't see what's being broke out. Once the market reverses back into the channel, it usually tests the bottom of the channel, and then eventually the channel evolves into a trading range. The minimum target when the market reverses back into the channel is one tick below the bottom of the channel. That's not the maximum target, that's the minimum. And eventually the channel becomes increasingly two-sided, and the market turns into a trading range. Here's that bear channel that I showed earlier. We broke below the bottom, and then a tail, a failed breakout, a bull signal bar, and we rallied up to the top of the channel. The minimum target was one tick above the top of the channel. The market ran up so strongly that it broke out and went quite a bit above the top of the channel. It does not have to stop here. It can break out. Fade channel breakouts. Okay, that means look for a trade in the opposite direction. All right, so you look for tests at the top and the bottom of the channel. You look for a breakout that fails, and then when there's a reversal, you enter on the reversal with the objective of the market testing the opposite side of the channel. It doesn't matter if it's a bull channel or a bear channel, or it doesn't matter if it's the top or the bottom of the channel. Here's a wedge. A wedge is a type of a channel. We have a bull breakout, and we went down, and then we went up again, and we're going down again. So we have a micro double top, and we have a bear signal bar. So that would be a reasonable short. You'd go short at one tick below the bear signal bar, and your initial stop would be one tick above the top of the signal bar. After you have a strong bear bar like this, opening on its high tick, closing near its low, you can tighten the stop to one tick above its high and calculate the actual risk. So your entry price is here, one tick below the signal bar, and your actual risk at this moment is one tick above the entry bar, and 2 times the risk is down to this red line. So since you're shorting in a bull trend, the probability is not all that high, especially with all of this buying pressure. You need to go for a reward that is twice your risk to compensate the relatively low probability. So you might exit all or half with a limit order at 2 times your actual risk. With luck, the market may trade all the way down to the bottom of the channel. Another big bear bar, so you'd probably tighten the stop to one tick above its high, which would be around break even. Remember that channels tend to evolve into trading ranges. We have a high 2 buy and a bull trend, and it's a possible final flag. A magnet, the market usually comes back to it, and here we broke below it and we're trying to reverse up. So this could be the start of a trading range. It's also a high 4 buy. There's a high 1, a high 2, high 3, high 4. 4 pushes down, and channels often end with high 4s. So this is a reasonable location for taking final profits. A high 4, possible failed breakout below this bear flag. Okay, so what's going on here? All right, we have a bear channel. The bottom of it is a trend line. We have a break below the trend line, and now we have a rally testing the bull high. So this is a double top major trend reversal, a double top over here, and it's also a low 4 short. 1, 2, 3, 4. Channels often end with low 4s, and this is a channel. And we have a decent sell signal bar, a bear bar closing on its low. So we should get a second leg down from this wedge, and that is a reasonable short for a swing down. And you can see what happened. We got a good entry bar, decent follow through. 4 bars down, so probably sellers above. I would not buy above that bull bar after these 4 bear bars. And then the market collapsed. Sometimes the market does not quite reach the line and it reverses before the line. Okay, so sometimes it gets close to the line but doesn't quite touch it, and then it reverses. If the context is supportive of a reversal and the signal bar is strong, you can take the reversal trade. If it's not, wait for clarity. Okay, so here we have a channel. It's a triangle, 3 pushes down, 1, 2, 3, and the market has a doji inside bar here, a high 2 buy. There's a high 1, high 2, and it's trying to reverse, but it's not quite down to the bottom of the channel, down to the trend line. So should you buy that, or should you wait to see if we get down a little further? Okay, a triangle, but we're getting higher lows, right? So it's a trading range, but it's also a bull trend. Why is it a bull trend? Because it's getting a series of higher lows. Here's a low, higher low, higher low, higher low, possible higher low, right? So it's a trading range and a triangle type of trading range, but it could also be a bull trend forming a series of higher lows and ultimately breaking out to the upside. So is it okay to buy above this bar? Sure. What's the probability? Maybe 50-50, right? Maybe 50-50. If you take this buy, the probability is not high enough not high enough for a scalp. So you're taking it for a swing. If you're taking it for a swing, you're using a swing stop. So if you take that buy, I probably would put the stop above the most recent higher low. Okay, so it's a high 2 buy setup, doji signal bar, not strong, and not quite down to the trend line. So you can buy for a swing, or you could wait. So if you bought it, you'd have a bull entry bar, which is good, and good bull follow through, and then a small sideways move here. It's actually a tiny triangle. The market went down and up, and then down, so it's a small triangle, and it's a pullback from this bull breakout. So that's good for the bulls. So if you did not buy here, we have 2 bull bars here, this would be a reasonable buy, even though we never hit the bottom of the channel. If you bought here, the signal bar is only 4 ticks tall, so the initial risk is 6 ticks, 1 tick above the signal bar, 1 tick below the signal bar. With a bar that tiny, I would go for more than 2 times the risk. If your default stop typically is 10 ticks in the spider, you might try to get 10 to 20 ticks if you're going to have a limit order in the market to take profits. Otherwise, you can wait to see what the price action is. Maybe you can go for a profit target just short of a measured move up, maybe from this low to this high. Okay, so if you bought here and you took half off at 10 ticks, you were not alone. Look at the big tail on the top of the bar. So a lot of selling took place around that price level. Bull breakout, so probably good to raise your stop to below its low, and you could swing the balance of your trade. Here we have an even stronger bull breakout, but we only have a few bars left to the day, so you could exit on the close of this bar, you could exit below its low, or you can exit at the close of the day. What about a with trend breakout of a channel? All right, so if you have a bull channel, suppose it breaks to the upside instead of to the downside. a bull channel is a bull trend, suppose you get a bull breakout of the bull channel. Most of the time, the bull breakout fails within about 5 bars, and the market reverses back into the channel and then tests the opposite side of the channel. Sometimes it does not. Sometimes it begins a stronger trend. Most of the time, when you have a width trend breakout of a channel,